The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. It's Paul here, just doing a quick audio and visual check. Hopefully, you can all hear my voice. Hopefully, you can see my screen, and we'll look to begin in the next moment or two. Super. Well, good afternoon, everybody. It's Paul here. Here we are, Monday, 20th of August, 2018. This is the fourth week of Mastering the 4 M's of Trading series of webinar, where we sort of talk through developing you as a trader so that you're in a position to master those the 4 M's of trading, which I will reveal them to you in the next few slides. As always with these sessions, so just start with a quick risk disclosure. Forex and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 83% of retail investor accounts lose money when trading CFDs with this provider, Admiral Markets. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Please ensure you fully understand all risks involved. Forex and CFD trading is a risky activity, and this presentation and accompanying video should not be taken as advice for investing, as they only represent the personal opinion of the authors. The presentation and accompanying video is for information and educational purposes only. As of August 2018, the regulation within the European Union differs for retail clients and professional clients. In our presentation, we use demo trading accounts, where all clients could still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading teams. Retail clients benefit from unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits with the maximum payment of £50,000 sterling as per our negative balance protection policy. As always, we talk about, why work with Admiral Markets as your preferred broker. Well, as well as providing a wide range of possible markets and instruments to trade in terms of especially the sort of the DAX 30, a very popular trading instrument. They have, exceptionally competitive spreads of 0.8 points during the main trading hours. And they also provide their own Admiral MetaTrader Supreme edition of both MT4 and MT5, which is a wonderful tool for traders to use. If you have any questions about Admiral Markets or about the products, the instruments, and the trading platforms they operate, then please by all means get in touch with your account representative, and they'll be very, very happy to discuss that with you. So for those of you who don't know me, ladies and gentlemen, I said my name's Paul Wallace. I'm a trader and an analyst and also a coach to traders. I started trading in the late 90s after sort of exiting the Air Force. Then I was in London at the time of the dot-com bubble, and I started trading equities then. And then over the years, I sort of transitioned towards being a full-time trader, also being a fund manager, and then also sort of coaching traders from complete beginners through to high performance traders at tier 1 institutions. So trading has provided me with a wonderful lifestyle and allows me the opportunity to spend my time between London and farms in Ireland as well. So I have a lot of experience of trading lots of different products, different instruments, different markets, and also actually from educating, mentoring, and coaching traders over the years. And I'll be sharing some of that with you during this series of webinars, ladies and gentlemen. In particular, in terms of my trading approach, primarily I describe myself as a discretionary-based method trader. That will hopefully become more sort of understand that better as we go through our sessions. Primarily, I consider myself a swing trader. Most of my traders are open for like a few hours to a few days, and sometimes a few weeks or a few months. I'm a big fan of simplicity in trading. Okay, human beings, myself included, we very often make things more complicated than they need to be, and so I'm very big fan on keeping it as simple as possible when it comes to traders. I look to blend fundamentals, technical sentiment, and geopolitics into my sort of decision-making framework, which is what we've touched upon on one or two of the previous sessions, and we'll run through our sort of underlying all of our remaining sessions. Primarily, sort of my main focus is on FX, indices, and commodities. I do trade a little bit in equities and crypto, and very, very rarely on fixed income, but primarily FX and indices and commodities are where the majority of my trading goes. And with regards to those particular markets, my strategy is very simple in that I'm looking to buy strength and sell weakness. That's as I said, I like to try and keep it as simple as possible. Buy strength, sell weakness, look for pullbacks for entries. Okay, look to do a bit of picture building, and then sort of mostly execute and manage trades on daily and 4-hourly charts. And as we go through these series and we sort of build on it session after session after session, hopefully you'll start to get a bit of a good understanding about how I particularly trade in terms of the swing trading. So primarily for my swing trading, I'm a trend trader. I'm always looking to find where is the dominant trend, and then try and sort of get on it and stay on it where I possibly can. And then for my intraday trading, which probably only makes up really about sort of 10 to 20% of what I do, well, actually I'm the opposite way in terms of my intraday trading. I'm primarily a mean reversion trader there. I'm looking for a price to overextend, and then when it looks like it might revert to the mean, that is where I'm looking to operate as a trader on sort of the shorter time frames. And as I said, over the sessions I will give you some insight into that to help you develop and define how your own trading style might evolve and grow as your trading experience rises. So, I like to set the expectations for our particular session. So it's for me to educate you all about the 4 M's of trading so that you're in a position to go away. And what I want you to do is to be able to analyze any market and be ready to trade it. Okay. What I talk about is trying to grow versatile traders. So, right? And how do I define a versatile trader? A versatile trader is somebody who can sort of trade any instrument in any direction on any time frame. I want you to be able to sort of have the decision-making framework and the skills and experience to basically look at whatever chart is in front of you and to basically be in a position to trade what you see. And by doing that and by educating that will also help you raise your self-awareness about managing risk and about managing yourself. So that's that's what I'm going to bring to these sessions. For yourselves in terms of expectations, I would just ask you to indulge me a little bit, of course, in the sense that we have 45-minute sessions every week. So in terms of the sort of the limits a little bit on the breadth and the depth of topics. So I would ask your forgiveness there. I appreciate that I have a broad range of experience joining us for our sessions. I appreciate some of you will be completely new, some of you will be very experienced traders, and I do try and sort of cover all the bases, but within the time I'm limited. I would please ask that forgive if I don't go into something as in deep detail as you would like. Then by all means get in touch with your account representative and have a chat with them about it. They'll be happy to help you. And primarily what I want you to focus on tools that you can use tomorrow. Okay, I can talk about lots of very exciting and intellectual and intelligent topics, but ultimately it's it's about you as traders, what you actually get to use tomorrow. So that's why these first at the starting of the sessions, they're quite simple, quite simple sessions as we start to build let's say like a baseline from which we can all operate as traders. And I'm just going to be giving you a little bit of insight on tools that you can use tomorrow in your trading, and we'll be looking at the Admiral Markets MetaTrader 4 Supreme Edition to be able to sort of help build a little bit of a portfolio of trades of our own. So here we go, the 4 M's of trading. If you're joining us for the first session, okay, I will try and briefly explain, okay, that what I talk about, whatever I talk to traders, whenever I talk about trading, whenever I'm engaging with trading clients, then I'm always looking at everything through the prism of the 4 M's of trading. Why is that? Well, what I think is that trading is made up of these 4 elements: the markets, method, money, and myself. Those are the 4 M's of trading. And why am I so keen and interested in them? Well, simply it's because what I've found over the years, okay, of in my own trading and from working in funds and actually from working with other traders, is that, there is a sweet spot, for a trader. And when a trader is aware of and managing and mastering those 4 M's of trading, that's when they tend to be in a sort of a sweet spot that allows them to operate at a better level as a trader. If you, as I said, if you're joining us for the first session in session 1 of these, which will be on our Admiral Markets YouTube channel, you'll be able to find the first session where I go around each of those four M's and go into a little bit more detail. And so, if you wish to brush up on that, then please make yourself available of that webinar in the in the archive there for you to be able to look at and to see. So throughout all of our sessions, I'm going to be touching upon those 4 M's. Okay, to begin with, we'll be doing a lot of focus on market and method, because as I said, I want to build up a little bit of a baseline of understanding about it. Okay, it's completely new traders. They tend to just focus on method. They just focus on market, which they do, but as you develop in skills and knowledge, you realize that that actually there's more to it than that. Okay, there is about understanding the markets that you're trading, whether they're actually even the right markets for you to be trading. There's about understanding all the different types of methods that you can use to engage with markets. Money management, okay, in terms of your risk management, money management, your trade management, okay, understanding your capital, your position sizing. That's actually is crucial, okay, because if you don't master that very, very quickly, then you're going to have challenges in your trading journey. And then finally, as you develop and as you become more experienced as a trader, you realize actually an awful lot of it is about managing yourself. All right, it's about making sure that you yourself are in a good place to be trading well and to making good trading decisions, because that's what this game is really all about. It's about decision making and the ability you have to make better decisions. Well, the likelihood is that you're going to make better decisions, you're going to have better choices. Okay, and with better choices tends to come better outcomes. So all of these 4 areas, they are important. Okay, and and I stress every week about just making sure, take a little bit of time just to effectively just understand, take a little snapshot of where you are in your own sort of trading journey and sort of how you are managing those 4 M's of trading at presently. Okay, if you're having 1 or 2 challenges with your trading, well then I can assure you that there's probably a challenge going on in one or more of those particular 4 M's of trading. So it's always a good time to take a little bit of a snapshot, to take a little bit of awareness of how you're trading, rather a little bit of a sort of a little bit of insight, a little bit of self-assessment, just so that you're in a position to raise your awareness and make better choices going forward. So as I said, we're going to focus quite a little bit on market and method to begin with. As I said, it's just about a little bit of education, a little bit of mentoring, a little bit of coaching in terms of establishing a baseline from which we can work. And and as I said, as the seasons unroll and as the series gathers pace, well then we will be looking in those other 4 areas. Okay, and I'll be sharing a few ideas on methods for you. I'll be sharing a few simple rule of thumb principles for money management, and also I'll be talking a little about about how we can manage ourselves. What do we need to be doing to be coming from our best place possible for when we're sitting down to actually to trade and engage with markets. So if you remember sort of from the last couple of sessions that we have done, we're talking about markets and method, and we're talking about a little bit about how it's good to have good habits. Okay, it's good to have good routines or processes. Okay, and I talk about for completely new traders, it's about having almost like a simple routine that you can follow. Okay, if I'm sure most of you will have at one point or another in your lives taken an airline flight. So when you go and sit on your airline flight, one of the reasons that you're comfortable and confident to do that is because the airline pilots who are there are there for years of training. Okay, a constant sort of exercises and training in the simulators, as well as a mounting experience as a captain or as a first officer on an airline. But it doesn't really matter. When the pilots turn up for that flight, it doesn't really matter whether it's their first flight in their career, or whether it's the last flight in after 30, 40 years of flying. Okay, they still go through their pre-flight checks, right? They still go through their pre-flight checks every single time. Why do they do that? It's because they make sure that they've got good routines, good processes, good habits. Okay, make sure that they are unlikely to miss anything, so that they're not likely to make a mistake. Okay, or a problem will happen. And it's a little bit like trading. Okay, that's it's about having just a simple routine that you can follow. Day in, day out. Okay, and the more you do it, the more it becomes embedded as to who you are, until it becomes almost like an automatic process. And what I was sharing with over the last couple of weeks is just we're just going to have a couple of little simple steps here that we'll build on. Okay, and that we'll sort of grow, and then as the series continues, we'll do a little bit more of advanced work on it. Okay, a little bit more of sort of a little bit more exciting sort of stuff. But as I said, create a baseline everybody can work with, everybody can work, understand from, and we'll take it forward from there. And that's what we talked about here. Okay, last couple of weeks. Step one, just whenever you open a chart of anything, it doesn't matter whether it's whether it's gold, or whether it's Bitcoin, or whether it's euro, dollar, whether it's BMW. Right, wherever we look at it, we start to look at defining levels of support and resistance. All right, we're going to start with support and resistance. As we progress and become more advanced, we'll look at areas of things of supply and demand. We'll look at strike zones, etc. that are of interest to me. But to begin with, just simple, define levels of support and resistance. We want to define if there is a trend, and we talked a little bit about that, and we'll touch on that a little bit more today. And then we're talking about we're identifying areas where we want to do our business. Right, we're identifying key areas where we think that something might happen in that market, and that's we're looking for that step three. Wait for see how price reacts at those key support and resistance levels. In particular, and what we'll be doing in sort of probably sessions 5 and 6 is looking more about let's have a look at some specific price action signals at that particular level, and is that going to give us the basis of a trade plan. And then step 5, which we'll do in a couple of weeks time, is is it part of a bigger chart pattern? Okay, is it part of something bigger? Okay, that we might be able to sort of identify and utilize to help us with our trading. It all comes down to sort of confluence of events. All right, what we're looking for is 2 to 4 things to be happening at a particular time and place in a market. That, as I said, is where we want to be doing our business. Okay, good traders let the markets come to them. Okay, all right. Bad traders chase the market. All right, it's like anything in life. You chase anything in life, it tends to run away faster from you. Okay, it doesn't matter whether you're chasing money, or you're chasing girls, or you're chasing trades. Okay, it's whatever you chase, they tend to run away even more. Okay, a good trader identifies where the market can come to him, and it's almost like sort of setting an ambush. You're waiting for the market to come to areas or zones where you're ready to pounce. Okay, where you're ready to do your business, and that's a good habit to get into. Okay, and it develops patience, and I can assure you, all good traders I know are patient. Okay, they have the ability to sit and be patient and wait for their trade to come to them. So if you remember, we talked about it, defining levels of support and resistance. We talked about just open a chart. Okay, I'm going to do that in a minute. Look at monthly, weekly, daily charts. Start to draw in horizontal levels of support resistance. Also have a little look at things like psychological round numbers. It might be like 120, 140, etc. Okay, depending upon the instrument you're looking at, right? And last week we talked a little bit about how you could use fractals to help you there if it helps you sort of identify particular significant levels of interest. And by all means, I said all of these webinars are in the archive on the Admiral Markets YouTube channel. So if you're a little bit unsure about what a fractal is, then by all means go back, and I think it was last week, session 3, that we talked about that. So by all means, just go and have a look at that, and very, very quickly sort of brush up on your knowledge base there. So, as I said, talked a little bit about defining levels of support and resistance. We also wanted to have a look at, can we define the trend? Okay, can we define the trend? And and this comes down to that 4 M's in the terms of the markets about, I need to know that you as a trader, you can identify whether an instrument is trending or consolidating. All right, I need to know that you can actively do that quite easily, quite quickly, and quite simply, because if you can't, right, then you're going to have troubles. If your method is a trend following method, but you can't tell that the market you're trading at the moment is, let's say, range bound, well then you've got there's a divergence there between your trading method and the particular market environment that you're in that particular instrument. Okay, it's not supporting you in what you're trying to do. So it's understanding. It's one of the first things we need to know. Okay, we can be able to look at our instruments and identify. Is there a trend in place? Okay. And then, unfortunately, markets don't trend as often as we'd like. You're probably looking at somewhere, every year a market might trend for only somewhere between 10 to 30% of its time, and the rest of the time it can be consolidating. So it's important to know that. It's important to be able to recognize that. Okay, and you might find as you develop as a trader, you might find that actually maybe you're better at trading ranges than you are at trading trends. There are it's everybody's different. Everybody has, let's say, unique sets of skills and perception of markets, and it's about starting to learn and work and understand that. That's what helps you become a better trader week after week after week after week. So, what we talked about, I think in session 2, was about one of the ways you can use to help you with defining that trend was basically, as we can start to use simple price action. Okay, I think session 2 we went through about identifying higher highs and higher lows for an uptrend, and identifying lower lows and lower highs for a downtrend. And as I said, these videos are all in the webinar archive, so by all means just go through and brush yourself up, and you'll find that week after week we're just, like, as I said, just building on your knowledge base. So, very simply, as you said, we can see here, this is the nice chart of the weekly chart of the DAX 30. Okay, you'll come to realize that I love the weekly charts. Okay, I think this, when you get a good trend on a weekly chart, well, you might get a trend there for somewhere anywhere between 4 to 9 months, maybe even longer than that, and that gives you ample opportunity to sort of get a little piece of the trend. But hopefully you can see there very quickly and very clearly, it's we can see where that market was consolidating over on the sort of the lower left hand side of the chart. The fractals there on the chart were helping us identify that the market was getting particularly range bound, and then we had a very strong breakout, and then, as you can see yourself, as we were getting sort of higher highs and higher lows there, it was just confirming that we were in a nice strong uptrend. Okay, it's very simple, ladies and gentlemen. So as I said, right at the very start, simplicity is key. Okay, we do, men in particular, and I am as guilty of this as any other trader, is that we sometimes overcomplicate things. We look at things and think, oh, it can't be that easy, or it can't be that simple. We need to overcomplicate it, and actually you don't. It's quite the opposite. All right. Is that a trend? I don't know. Is it, maybe if I turn it a little bit, or if I zoom out a bit, you find yourself having a little conversation and a discussion with yourself, well, then the likelihood is that is not a trend. Okay, that is not a trend. Good trends will leap off the chart at you, and if you don't see that, well, then there is no trend there. Okay, so we're here, we're starting as starting as, let's almost like rookie traders in terms of recognizing, well, I want to find trends that are ideally I want to find markets that are trending, and then I want to look at ways to sort of to get on board and actually to join those trades. So one of the other ways we can use to help us identify trends and to identify, let's say, the sort of the strength and the momentum of the trends is to use a very, very simple sort of visual indicator called a moving average. I suspect most of you will be aware of it. Some of you, as I said, are completely new, may not be. We'll just do a couple of slides on these moving averages, and then we're going to jump to the charts, ladies and gentlemen. So moving average, they're a popular trading tool because they're visual. Okay, visual. The majority of traders engaged in markets are male. Okay, males are very visual in most areas of our lives. Okay, make of that what you will. But it's moving average is a popular trading tool because it's a visual trading tool. Okay, it allows traders to smooth over the data, and moving averages, they can be used to gauge the direction and the strength of the trend, and that's in particular how we're going to be looking at them in this particular series, and also give you a little bit of an idea idea of momentum, but like any indicator, okay, like any, let's say any decision support tool in trading, they have pros and cons, okay. There is no perfection, all right. I'm sorry I can't offer you that, ladies and gentlemen. There is no perfection. It's about, sort of understanding the pros and cons and coming to a good decision place about, okay, how to leverage the strengths of any decision support tool and mitigate the downsides. So, if you have never used the moving average before, okay, it's effectively, it will take the sort of the data, sort of, the closed data of the last particular period, whether it be a daily chart or a 5-minute chart or a monthly chart, okay, and basically it will add up the last bits of the closed data and then take an average of that and then plot that on the chart. So this particular chart here, you have a 10-period moving average. So basically, every time a candle closes there, it will take it will add up the sort of the last 10 closes, okay, in that instrument, and then take an average of that number and plot that. And then, as I said, that gives you sort of a visual tool that can give you an indication of a particular trend, and also an indication of whether a market's consolidating or actually how particular strong that trend is. So not surprisingly, with the that's a 10-period moving average. But what we're going to do is we're going to talk about the pros and cons of lots of different numbers, moving averages, and I'll show you a slide on that in the next moment or two. So what I use for my own charts, okay, and you'll see this, and for those of you who join us on the real-time daily trading ideas, okay, 10 o'clock every morning London time, we Admiral Markets, we provide the real-time daily trading ideas, okay. I do the Tuesday morning session, so tomorrow at 10 I'll be there. But what I use is, I have on my charts, you just see I have a blue 20-period moving average, a red 50-period moving average, and a green 200-period moving average. Okay, so what we'll find is that of course the sort of the lower the number, all right, the sort of if like whether it's a 5 or a 10 or a 20-period moving average, that effect it's taking less data, so it tends to be a lot more reactive to the price. Okay, it tends to be a lot faster. Whereas slower moving average, something like the green 200-period moving average, okay, that moves at a lot of a much slower pace. Okay, that doesn't turn or trend as quickly as a sort of a faster moving average. But they all have their pros and cons. Okay, what you'll find is that if you go to trading conferences, if you go to internet forums, okay, and you talk about which is the best moving average, well then you've just opened a huge big can of worms, and you'll find that traders can scream and shout at each other that the 34 is better than the 55, which is not as good as the 62 weighted, which is nowhere near as helpful as the 10-period exponential moving average. Okay, it can be quite a rabbit hole you can go down, all right, and you'll find people who'll spend their entire lives trying to curve fit the ideal moving average to each individual market. And if that is of your particular persuasion or ilk or interest, then I wish you good luck with that. Personally, for myself, I'm just simply using this. Okay, I just want to have an idea of the sort of the trend that we're in, if there is one. Also, what's the sort of the strength of the trend? Is it is it increasing or is it faltering? And also, what I also find, and I become very interested in, is that you find that those moving averages, okay, especially just the sort of the majors, 20, 50, 200, okay, I'm interested in them, intrigued in them in terms of them becoming what I would call dynamic levels of support and resistance. That starts to get me interested. Okay, so hopefully here, let's see if I can use the wonderful drawing tools on our kit here. So here we can see, we can see that the sort of the 50-period moving average has been going up, and we can see that sort of every time it's come down to here, okay, actually every time it's come down there, it's bounced off it. Okay, it's come down and bounced off, come down, bounced off, come down, bounced off, come down, bounced off. So actually, when it finally does break beneath it, okay, when it does break beneath it, well, that gives me an indication that that sort of uptrend we had, the sort of that uptrend is likely over for the moment. Okay, and then actually, what we see is that the market rolls over and falls down for this is a 4-hourly chart, so it falls down for the next few days on Bitcoin. So so that's another one of the reasons I like to excuse me, to use moving averages is, okay, I also like them to see identify areas of dynamic support and resistance. And as we talk about trading methods, well, that will become much more useful and prevalent to us in the next few sessions. So here's what happened. When here's what people get sold, because very often what you'll find is people start their trading journeys with maybe understanding sort of being utilizing a simple moving average crossover system. So when a faster moving average crosses a slower one, okay, that's the start of a trend, and that's where we look to buy here, where the sort of the left arrow is, and then invariably once that it crosses to the other side, okay, once it crosses back beneath the sort of slow one, that's when you'd get out, and invariably you can see that that trend has worked nicely, and where had you bought in at that moving average crossover, okay, on the far left, and then got out on the far right, well then that was a lovely trade, and you'd be very happy, and you'd have made some profit on your trade. Unfortunately, it's not always like this, okay? As I said, remember, markets don't trend as much as we would like them to, okay? And so actually what can often happen is, when a market is consolidating, if you're just trying to trade moving average crossovers, and you're in a range-bound market, then all the profit you made on that nice trend, you'll end up giving back, okay, once that market goes into a consolidating range-bound environment, okay? So I don't advocate moving average crossovers as a trade entry signal, not in particular, okay? There's more to it than that, okay? But as I said, we're here to utilize moving averages as just an indication of trend, okay, and also an indication of dynamic levels of support and resistance, and one or two other sort of let's say advanced little ways that I use it, and then I'll show you them in future sessions. So we talked about we want to be able to identify as a market consolidating, or a market is trending. Sometimes, ladies and gentlemen, with the best will in the world, you can look at a chart and a chart's going nowhere, okay? You might want it to go somewhere, but the reality is it's not, it's going nowhere. So if you do find yourself looking at a chart and you can't work out whether it's going up or down, then as I said a little bit earlier, move on. All right, find a chart that has direction, okay? Then good trends will leap off the chart at you, okay? They will leap off the page at you, okay? If you're struggling to see that, if you're struggling to identify that, well then I can assure you then that there is no trend. All right, so it's there's a little common. The price quite often will move like a crab, okay? It knows where it's going, but it's not going there in a straight line, and that's perfectly applicable, okay? Markets never move in a straight line. There's always a bit of a zig and a zag going on, okay? And it's about being able to recognize that and understand it and put it within the context of the bigger market move. So, as I said a little bit there earlier, okay, a couple of final points of moving averages. You can spend your life trying to curve fit moving averages, and my advice is don't bother. Okay, as I said, I'm in trading conferences, and there'll all be people arguing and debating about which is the best moving average. All right, it's you could lose years of your life trying to do that. Okay, and maybe that might be your idea of a good night out, and if so be it. It's not mine. Okay, I'm basically just using moving averages to help me define a trend and sort of dynamic support and resistance areas. Okay, that starts to get me excited. As a general rule, avoid moving average crossover strategies. Okay, they work great in trending markets and work woefully in consolidating or range bound markets. So you want to avoid that. Okay, because as I said, you'll get just chopped about in range bound markets, and that's no fun at all. So, that's what I was saying there, okay? We're looking step 1, define level support resistance. 2, use what you can to define the trend. And then step 3, wait for price to react at key support and resistance levels. So that's what we're going to go and do now, okay? We'll go and have a look for the last sort of 15, 20 minutes of our session. We'll just wrap up the slides, and we'll go and have a look at this, okay? And we'll just build it and show you how you can do this for the new traders with us today. So, whoops. So, as I said, we're actually looking for a particular level of support and resistance, and we're going to talk about confluence of events. And I'm actually going to talk about that much more in depth in one of the upcoming webinars that we'll see. And we just want to have some simple ideas, okay? Just want to have simple ideas to begin with, okay? As you develop your ideas and methods and context within which you see and operate, markets will change, but let's keep it simple to begin with. All right, simplicity is key. When markets are bullish, you want to be a buyer. When markets are bearish, you want to be a seller. That might sound like I'm oversimplifying it, okay? And then you might sort of look at yourself and say, well, Paul, I know that. But there is a difference I find with traders. There's a difference between knowing it and doing it. Okay, very often markets, the traders might know that they should only be buying bullish markets, but invariably for reasons about poorly managing themselves, that invariably what they find themselves is trying to pick tops in markets, okay, or pick the bottom in markets, okay. They think that they have the skill set to do that, or they think that their ego is telling them that they know better than the market itself. All right, so there is a difference between knowing it and doing it. So just keep it simple. Markets are bullish, you be a buyer. Markets are bearish, you want to be a seller. Define the trend if there is one and trade with it. No trend, no trade, no signal, no trade. You keep it simple, okay? You keep it simple to sort of keep yourself from making silly, impulsive mistakes as a trader, okay? We've all made them, we all do them. We're all human, okay? We're all, it's all the human condition, right? But sort of eliminating as many mistakes as you possibly can is what will help you develop fastest as a trader. So we're going to look at step 1 and step 2 now, okay, and I have a little idea step 3, and then in the next future sessions we're going to be looking at price action signals at particular levels and zones, okay, and we'll cover them more in depth over the next few sessions as we start to sort of move from markets into methods. So, remember what I was saying. I say this every time, is that people talk about how they make their trading decisions, fundamentals, technical sentiment. The reality is nothing more than a decision-making framework. Okay, do you buy, do you sell, or do you sit in your hands? That's actually it. That's what it all boils down to. So as I said, keep it simple for yourself. All right, keep it. It's better to have a simple trade plan that you can execute perfectly every time, rather than an amazing trading plan but which you struggle to execute because it's just too complex, or it's too opaque or arbitrary. All right, just simple, robust, objective and consistent way to make one of those 3 decisions. All right, I look at a chart, am I going to be a buyer, am I going to be a seller, am I going to sit in my hands? And that and that's what we're going to be doing on these series of webinars, is about helping identify what you need to create that decision-making framework. So finish up the slides, okay? Remember, you want to always be managing those 4 M's of trading: markets, method, money, and myself. Check in with yourself every week, okay? How have you done? Score yourself out of 1 to 10. How have you done this week on managing those 4 M's of trading? If you're having a bit of a trading challenge, well, identify where is it in those one of those 4 areas that you might be having challenges, okay? Because I can assure you, that the likelihood is the answer is going to be in one of those, and the quicker you raise your awareness on it, the quicker you can actually do something about it. And as I say every week, these sessions are all about weaving those 4 M's together, starting to pull the markets, the method, the money, and myself, start to pull it all together, to weave it so that you actually have a way to objectively and accurately engage and trade with financial markets. So we're going to have a little look at our MT4, okay? We're going to look about building our profile. We'll do a little bit of analysis. We've got a little bit of time, okay? And if there's any questions, we'll take them. If you have questions, if you're watching this in the webinar archive, then by all means you can get in touch with your account representative at Admiral Markets. You've got the London number there, 020-726-4003. You can email them at hello@admiralmarkets.com. As I said, these videos, okay, and others are on the YouTube channel, and they also have a Facebook page there that you can join on that, okay? So if you have any queries or questions, by all means get in touch with your account representative, and they'll be very happy to help you with your queries. So if you just bear with me, I'm just going to sort of switch across to the charts, and let's have a look at what the markets are showing us today. So I hope you can all still hear my voice. Hope you can all see the screen. This is the Admiral Markets MetaTrader 4 Supreme Edition. Excuse me, I just take a little sip of water, talking for 40 minutes, just to keep wet the whistle. So what I've got here is, for those of you who are quite new to MetaTrader, okay, what I have is a series of profiles. Okay, this one I've called it the 4 M's of trading. Okay, what I've got here is we've got a sort of series of profiles with the dollar charts. Okay, so if you can look at, I've got euro dollar, pound against dollar, Aussie dollar here, Kiwi dollar, dollar Swiss franc, dollar yen, dollar CAD, And then here we have the dollar index. Okay, I'll do a slide on specifically on the dollar index in one of the next week or two sessions, just to give the new traders, a bit of a better understanding of the dollar index. Is effectively is a basket of the dollar against the vast majority of the major currencies. Euro dollar, the euro, sorry, makes up about 57% of that, which means that the dollar index chart, okay, and the euro dollar chart can be inversely correlated quite nicely, and that's a useful idea to know. But let's start. We're looking because the FX markets are the biggest markets, okay. And if you're going to be operating in the FX markets, well then we need to be looking at the dollar index. So remember what I was saying here. When I'm bringing up a chart, this is the sort of here we go. It's the monthly chart of the dollar index here. Just moving this tab around here so we can sort of utilize and draw. And then what I'm looking at, just starting very quickly, very simply. The monthly chart here, okay. Remember what I said, I've got green bullish candles, red bearish candles. I've got fractals, okay, on here. So I might just make them a little darker than normal, okay, just to help you see them. Okay, if you don't know where to find a fractal, you can go up to here on the top left. You can go to Insert, Indicators, go down to Bill Williams, and you'll find them there, okay. So you can find them there to use, okay. And as I said, if you're not really sure what a fractal is, go and have a look at the session 3 video where I touch upon that a little bit more in depth. So realistically, what I'm looking to do is, I'm just looking to draw in levels of support resistance where there are extremes, okay, where we had extreme up here after sort of Trump's win in 2016. We had a sort of a bit of a high there for the dollar, 103. Okay, so I'm interested in where I see those particular areas. And then the fractals can help me, okay. When I start to see fractals, quite a lot of fractals, okay, happening around about a particular level there, okay, about 78, 79. That gives me of interest, okay. So I'm just starting that on the monthly chart, all right. I can see that there's you can see we had one here, okay. We've had areas there where prices come up, come down again. So I'm intrigued by that, okay. So as I said, I'm just looking for particular areas where there might be the opportunity for me to sort of see how the market reacts at that particular level. So that you do that on the monthly chart, because the MetaTrader chart will keep your lines in place, okay. So you don't actually once you've done it once, all right, in your charts, you don't really have to go back. You just need to keep updating it as we get more data. So then I'll go down to the sort of the weekly chart, okay. Now of course as we go down, there'll be a lot more, okay, of fractals and ideas. But the whole idea is that I'm just wanting to sort of identify significant levels of support and resistance, okay, or particular patterns. So back in the day, I was curious about this pattern here, okay, where we had a triangle there pattern just forming, and that was on the weekly chart there. Hopefully you can see that, and we can see how that operated quite nicely, and then as I said, I'm looking just for particular areas here, okay. We can see that we can see here on the dollar index chart, okay, that actually what happened was, over at the start of this year, and you've heard me talk about it on our real-time daily trading ideas, okay. We've I talked about how dollar coiled up before it exploded, and you can see that it actually ran up very nicely. And then recently, it broke this kind of 95 level, and we had a significant move up for it. And now we're looking at, it's probably last couple of weeks of August, people taking a little bit of break, a little bit of profit, okay. The majority of the big guys, okay, they'll be sat on their yachts in the south of France enjoying themselves, okay. So the markets tend to take a little bit of a breather during this particular period, okay. So it gives us a chance to sort of catch up. And then if there's a particularly, I'll go down onto the daily chart, and then as I said, just sort of draw in some significant levels of support and resistance, or any particular sort of trend lines or areas that start to get me interested in a particular market. And so very quickly there, we've just done a little bit of a bit of an analysis there, okay, on the dollar index chart, okay. The monthly chart is perhaps a little bit too big, okay. We're in a bit of a bind there, okay. But definitely we can see that on the weekly chart, we can see that basically a price has been since the start of April, the price has been just in an upward trend, okay, over the last 4 or 5 months, and definitely on the daily chart, you can see it very clearly that that price is basically, and the dollar index has been basically moving up nicely. Hopefully you can start to see as well, the sort of the 20 period moving average, let's put my cursor on, 20 period moving average, okay, has acted as some dynamic support, and the 50 period moving average has also acted as some dynamic support, okay. And I was curious, this on the real-time daily trading ideas a couple of weeks ago, I said that if price broke the 50 period moving average and that trend line, well then I'd be seeing us move probably down towards the 200. That's what my plan was if it happened, but if not, it would likely go the other way and break that 95 level, and that's what it did. It didn't break those levels. It turned around there, shot up, okay, broke through, took a little breathe, and then carried on, okay. And you can, that's an indication of dollar strength in the world. And if you're going to be operating in FX markets, it's imperative that you know what the dollar is doing, okay. You need to know, is the dollar trending, is the dollar consolidating, is the dollar awake, is the dollar asleep, is the dollar angry, okay. It's like it's the big silverback gorilla in the room, okay. You don't want to pick a fight with it, okay. You don't want to pick a fight with it. You want to know what it's doing and know, do I follow behind it? Do I get out of its way, okay, or do I look elsewhere, okay? So not surprisingly, we just talked about how that the dollar index is pretty much inverse correlated with the euro dollar. So if I look at the chart here, okay, and it's just the same the same thing of starting off on starting off on the charts, on the monthly charts, okay, identifying particular areas there, okay. Just as I said, it becomes almost like a it's automatic, okay, automatic routine that you do, just identifying the extremes, okay, the particular areas that are of interest to us. All right, just identify extremes of markets, okay, where I can see particular significant levels of support and resistance going down, okay, from the weekly chart there, okay. So remember, I was talking about dollar index. We saw price bottoming out and then blowing north, okay. And what we had here on the euro dollar was price kind of 125, okay. Just didn't want to get above it, and then price coiled up and it dropped away, and then we hit 115. A bit like 95, okay, and actually in the same way, 95 we broke going north on the dollar index. 115, okay, we broke going south on the euro dollar, okay. It's inversely correlated, and what we see at the moment is that I can see that is in a downtrend. What we do have is that this weekly 200 period moving average. See how, hopefully you can see how it's whenever prices gets there, okay, there is a reaction, okay, there is a reaction. And what we saw last week was actually, kind of a bullish candlestick off the weekly 200 there. Okay, that's the sort of that was the dip into it. Okay, so I'm going to be interested to see how that plays. Maybe we'll drift up a little bit towards the back towards that 115 level. Okay, I'd be interested to see that. Maybe drift up there. Just as people start coming back to their desks after the summer holidays, and then we'll see how that particularly plays out. But hopefully, you can see that just very simple, okay, just very simple, just looking at the charts, okay, and looking at what we can see in terms of identifying a particular trend on the big particular markets. That also starts to bring us into into what we'll look on in one of the next sessions or two, is about understanding how we're technical traders and trade what we see, but we can start to build in pictures from the fundamental markets, okay, in terms of understanding that how the dollar strength, okay, where that's coming from, and the impact that is having on particularly emerging market currencies, but also even just on the major currencies, okay. And that we'll do a little bit more on that next week, I think, when we'll look at how that has had an impact upon China, and how that's had an impact then upon the Aussie dollar and on the Kiwi dollar as well. So there we go, ladies and gentlemen. Just finishing the session there. If you have any particular questions, I'll happily take them. Or alternatively, as I said, if you're watching this in the archive section, you have questions, then by all means get in touch with your Admiral Markets account representative, and they'll be very, very happy to discuss with you and help support you. Thanks for joining me this week, and remember. Be here every Monday at 4 o'clock London time every week, just building just a little bit more, okay, session by session, starting to, as I said, build a baseline plan to operate with as I help you develop and learn how to manage and master the 4 M's of trading. So thank you very much, ladies and gentlemen. I hope you have a great week and trade well, and I look forward to speaking to you soon.